everyone, welcome back to the channel X and Yong. The market is down, but don't get panicked. Remember that we are having a long-term mindset that the main point is to always stay invested. Short-term results can be very volatile and nobody can predict what will happen next month, next few months or next year. Let's apply the ground rules that Warren Buffett once said, investing in the deep value as what we have known for as the value investing strategy. We should focus on buying good stocks or good businesses with good fundamentals. Stay invested unless there are better opportunities elsewhere. Of course, when it comes to picking stock, there must be something we can use to compare with. Let's take a quick look at the S&P 500 stocks, the 500 leading publicly traded companies. I have downloaded the list of 500 companies. You can refer to the link in the description below. Fun fact, there are 505 names in the S&P 500, even though there are only 500 companies. How come? The reason is some of these companies are having multiple share class. For example, Google. The company name is Alphabet. There are share class A and share class C. Share class A gives you the voting right and share class C does not. Those two share class are publicly traded, but share class B stocks are not publicly traded and therefore not in the S&P 500 list. The 500 companies are categorized into 11 sectors. By sector-wise, information technology sector make up of 28% of the S&P 500, followed by healthcare 13.6%, consumer discretionary 12%, financials 11.1%, communication 9.4%, and others that make up of the balance 25.9%. The index weighting will be changing from time to time as some of the companies might be removed and replaced when they are not able to meet the S&P standard. Among the 500 companies, how do we want to pick the stock? Well, first of all, very importantly, we should focus and invest within our circle of competence. Focus on the sectors that we are familiar with. It can be companies that produce products or services that we are using. If we are not sure where to start, let's take a look at the largest companies, meaning the largest market capitalization. The top 5 companies are Apple, Microsoft, Alphabet, Amazon, and Tesla. I think most of us are familiar with Apple as an example, which belong to the IT sector. Let's filter to only IT sector. The top 5 are Apple, Microsoft, Nvidia, Visa, and MasterCard. How familiar are we with their products? Apple, we have been using their iPhone or MacBook or iPad. Microsoft product could be Microsoft Office. Nvidia is actually producing the GPU, graphic processing unit for most computers. MasterCard and Visa are actually, if we are using bank debit or credit card, they are the payment processing networks. Those 5 companies are the leaders in the IT sectors based on their market cap size. They are huge and well known. For long-term investing, we should assess if the IT industry will still be doing well in the next 3 to 5 years. What will be disruptive to the IT industry? It might be the blockchain, artificial intelligence, AR, VR, or the Internet of Things, and many more possibilities. This is linked to the company's strength in terms of the leadership team if we are investing in the company for long term. How strong is the management team and are they innovative and strategic in handling the possible disruption? The information of the company management team are publicly available information in terms of their experience, their age, their salary. So for example, in Apple, Mr. Timothy D. Cook is the CEO of Apple. He has been the CEO since 2011, was previously a COO since 2005. In Microsoft, we have Mr. Satya Nadella as the CEO since 2014. He joined Microsoft since 1992. It seems that most big companies are emphasizing on internal talent. This is definitely a good sign. Next, we will focus on the companies with good fundamental for long-term investing purpose. Good fundamental meaning having growth in the earnings per share, EPS, in other words, profitability. Having reasonable leverage ratio. Possibly, we prefer those with lower debts. Having good return on equity, ROE. Having positive cash flow. All these figures can be found in the company annual report, and you can do your quick calculation. We can also search online from other platforms. As of current, Apple is having the most net income of $94 billion, but its earning per share EPS for the last 12 months is 6.16, which is lower compared to Microsoft and MasterCard, despite Microsoft and MasterCard are having lower net income. Remember, EPS is the net income divided by total number of outstanding shares. It could mean that Microsoft and MasterCard are having less outstanding share compared to Apple. With higher EPS, it is good to the investor as they are able to get more out of the net income. By EPS, MasterCard has the highest EPS, followed by Microsoft, Visa, Apple, Nvidia. By return on equity (ROE), MasterCard having the highest, followed by Apple, Nvidia, Visa, and Microsoft. As long as the debt to equity ratio is less than 200% and there is positive free cash flow, those are considered financially healthy. A quick glance, MasterCard is having the highest leverage as compared to the other 4 companies. If the company continue taking more debts, this could be a red flag to take note. If you believe in the industry and we are fine with the company's fundamental, the next important thing is the right pricing. There are 3 straightforward ratios that are easily accessible and can be checked, which are the price to earning ratio, PE ratio, price to book value, PB ratio, and price to sales, PS ratio. Those are using the current financial data which we can get from the annual report. However, those 3 ratios do not consider the future growth rate. So in this video, we are looking at the price per earning to growth ratio, PEG, to check if the company is over or undervalued. PEG ratio is more than 1, meaning the company is overvalued. If PEG is less than 1, meaning the company is undervalued. How do we assume the growth rate? Yes, this is purely based on assumption. We can refer to the EPS growth rate for the past 5 years track record to compute. To make the example easy, I will use the annual EPS compared to 3 years ago. Of course, you can also compute using the latest EPS, assuming the companies are able to grow at the same rate as per track record. The PEG ratio are less than 1 for Apple, Microsoft, Nvidia, and MasterCard, meaning undervalued, except for Visa, which is having a PEG ratio of 1.1, slightly overvalued. Conservatively, we use the second assumption, the growth rate assumption of 30%, we derive a new set of PEG, which only Apple and Microsoft are undervalued. Visa stock is still a good buy if it continues to grow at 30% per annum, while Nvidia and MasterCard are overvalued now under the assumption 2. Remember that these are only assumptions. Do comment below what is your assumption of the future growth rate for these companies or for the IT sectors. I'm sure you have a different views and method to compute it. In short, this is just a simple run through on how we can pick some good stock from the S&P 500. To recap, we should invest within our circle of competence, do our own due diligence on the industry and business analysis. Then we will also check on the fundamental of the companies if they are financially healthy and are growing. At last, there are a few methods to evaluate if the company is over or undervalued, either using the PE ratio, PB ratio, PS ratio, compare with the sector average, or we can use the PEG, price per earning to growth ratio, based on the assumption of future growth rate. PEG ratio is to assess the growth company, not dividend type of companies. If the result is less than 1, then it is undervalued. Alright, hope you enjoyed the video. Do share with us how you would pick a stock from S&P 500 for long-term investing. Subscribe to our channel for more content like this. Thank you and see you again in the next one.